Oracle reported results for its first fiscal quarter on Tuesday that resulted in a massive breakout for the stock. Oracle's shares soared 36%. That helped light a fire under AI stocks and caused both the S&P 500 and the Nasdaq stock indices to advance to new highs. Adobe reported its third quarter earnings for fiscal year 2025, showcasing robust financial performance and significant advancements in AI integration. The company exceeded analyst expectations with a non-GAAP earnings per share of $5.31, surpassing the forecasted $5.18. Revenue reached $5.99 billion, also beating the anticipated $5.91 billion. Oracle reported blowout first quarter earnings amid cloud strength and strong momentum in AI products. Oracle's shares surged chiefly because of a massive expansion in a key figure called RPO, which is short for remaining performance obligations. That indicates a rapidly building order backlog. I like Oracle's investment setup, growth profile, and its underdog status in the cloud computing market. While Oracle has a relatively low market cap relative to rival companies, I believe the firm has one of the best growth profiles in the rapidly expanding cloud market. The cloud computing giant missed both bottom line and top line estimates for the first fiscal quarter of fiscal year 2026 on Tuesday, but nonetheless submitted a blowout earnings report thanks to growing cloud adoption. Oracle reported adjusted earnings of 1.47 cents per share, missing the consensus estimate by only 0.01 cents per share. The top line came in at $14.9 billion and missed the average prediction by $117 million. Oracle is a cloud computing company that is benefiting from a massive enterprise interest in artificial intelligence. While companies like Amazon Web Services, Microsoft, and Alphabet are dominating the market for cloud service providers, smaller enterprise platforms like Oracle or CoreWeave are also seeing a massive acceleration of AI-driven growth in their cloud operations. Oracle is a relatively small player in the market and a so-called second-tier computing firm with an estimated market share of 2 to 3%. AWS still dominates the market with a share of 32%, followed by Microsoft's Azure with a weight of 22%, and Google Cloud with a share of 11%. A massive spending spree in the data center market, which is tied to advancements in artificial intelligence, is why cloud infrastructure services are booming. According to market intelligence firm Synergy Research, corporate spending on cloud infrastructure services increased to $99 billion in the second quarter, showing 24% year-over-year growth. Further, cloud revenue growth in the sector is accelerating as companies spend more money on generative AI services. However, even smaller cloud platforms like Oracle can tap into the hungry enterprise sector and their insatiable demand for generative AI. In total, Oracle's revenue surged to $14.9 billion, showing a 12% year-over-year increase in the second quarter. The cloud computing platform reported revenue of $7.2 billion in its most important segment, showing a massive 28% year-over-year. The cloud business is expected to grow to $144 billion in cloud revenue by fiscal year 2030, compared to an expected revenue volume of $18 billion this year. However, its RPO, or remaining performance obligations, soared 359% year-over-year to $455 billion, driven by interest in the firm's cloud offering. RPO is an important platform metric for Oracle because it highlights the total monetary value of services the enterprise needs to perform for its clients under current contracts. Therefore, it is a strong indicator of future revenue growth, which is directly tied to the spending boom in the public cloud infrastructure business. In terms of free cash flow, the enterprise is on an aggressive spending spree as well in order to build out its cloud computing capacity, which is currently resulting in negative free cash flows. Oracle generated negative free cash flow of $5.9 billion on total revenue of $14.9 billion in Q1 2026, which was mainly due to surging CapEx spending. Investors should expect Oracle to remain free cash flow negative for the foreseeable future as the cloud enterprise is doubling down on its cloud investments. The firm raised its CapEx outlook to $35 billion for the current fiscal year. In fact, Oracle has the fastest CapEx growth in its business, outperforming even companies like Amazon and Microsoft in terms of percentage increase. Despite the 36% increase in market valuation, I am initiating Oracle as a buy because the enterprise not only has double-digit growth momentum in its core business, but as a second-tier cloud computing firm, also has significantly stronger potential to expand its market cap than more established cloud platforms. Currently, Oracle only has a market cap of $922.55 billion, which pales in comparison to the market values of Amazon and Microsoft. Oracle is currently trading at a forward price-to-earnings ratio of 40.8x, which compares against valuation ratios of 30.4x and 27.5x for Amazon and Microsoft. The massive increase in RPO, enormous growth opportunity in the cloud segment, and very bullish sector outlook, paired with Oracle's low market cap, create an interesting investment setup despite a 36% share price increase on Wednesday. I believe Oracle could earn $10 a share in EPS next year, which is more optimistic than the current consensus estimate of $8.08 a share, because I believe CapEx spending is going to massively accelerate in the data center industry. A 40.0x forward PE ratio applied to Oracle's estimated EPS for next year implies a fair value of $400 a share, implying up to 22% upside revaluation potential. As a second-tier cloud computing company, Oracle is subjected to the potential risk of a deceleration in AI-related investments on the part of enterprise clients that want to access generative AI technology. As unlikely as this is, in my opinion, it is a risk that investors need to consider. What would change my mind about Oracle is if the enterprise were to see a slowdown in customer interest in generative AI technology. Further, a failure to turn around free cash flow margins in the long term could potentially get me to change my mind about the cloud computing firm. Cloud computing is a big business, and one of the companies that seems primed to really accelerate its growth here is Oracle. As a relatively small second-tier player with a market cap of less than $1.0, I believe Oracle is one of the most attractive growth plays in the cloud computing market, especially with its RPO soaring. Oracle is currently investing heavily in the build-out of its AI-driven cloud platform and has submitted a huge, impressive cloud revenue guidance for fiscal year 2030, implying an 8x factor increase in the segment's total top line. While shares trade at a 40.0x PE ratio, the company has massive growth tailwinds and is expected to see a drastic increase in its EPS going forward. I think these results are very strong, and I expect the stock to recover some of its recent losses in the coming months. Many people worry that AI could disrupt Adobe, but the company continues to deliver solid performance quarter after quarter. I plan to hold this stock for the years ahead. Let's have a look at their financial data. Adobe reported record results for the third quarter of 2025, with revenue reaching $5.99 billion, up 11% from last year. Growth was driven by strong demand for both its creative software tools and business solutions, as well as increasing adoption of AI-powered features, which have already contributed more than $5 billion in annual recurring revenue. Profits and cash flow were solid, and the company also repurchased 8 million shares during the quarter. Given this momentum, Adobe raised its full-year targets. For 2025, it now expects around $23.7 billion in total revenue, with steady double-digit growth in both its digital media and digital experience segments. Full-year earnings per share are projected between $16.53 and $16.58 on a GAAP basis, or between $20.80 and $20.85 on a non-GAAP basis. Fourth quarter revenue is expected to exceed $6 billion. Adobe attributes its performance to strong customer demand, ongoing innovation in AI, and successful execution of its growth strategy, while also acknowledging risks such as economic conditions, competition, and the challenges of scaling AI responsibly. That's all for today. See you next time.